Welcome back, everybody. We're so glad you're still here with us, or if you just joined us, we're so glad you're just joining us. This is the 12th year of CPA Practice Advisors Ensuring Success Conference, and this is the 6th session of the 12th year. I'm Gail Perry, Editor-in-Chief of CPA Practice Advisor. And for those of you who want to talk about us on social media, because why wouldn't you, our hashtags are December CPE and Ensuring Success 2025. So please spread the word amongst your social followers. Just a few housekeeping items before we get started for those of you who are just joining us. Each session that we're doing here is a panel discussion, and by discussion I really mean discussion, and they're interactive. So you can send questions to us if you want. We'll get them on the set and share them with the speakers. The question box is at the bottom of your screen below the window that you're looking at right now where you see me. It says ask a question, and you can ask a question in that box. If you have a question about a tech issue or something that isn't going right on your screen, or a question about CPE, we have people standing by to answer those questions, and those questions go up at the top of your screen. There's an email address, info@ensuringsuccess.com. There's also a phone number if you prefer to text your question. So those are for your technical problems. Questions below are for us up here on the set. Ensuring Success would not be possible without the support of our sponsors. And so I'd like to take a moment to just tell you the names of the sponsors who have come on board with us and made this event possible. And they are ADP, Avalara, Canopy, CPA.com, Digits, eFile4Biz, Field Guide, Carbon, Count, WriteWorks, SafeSend, SureLink, ValueInsights.ai, sorry about that, Walters Kluwer, and Xero. And in particular, the sponsor for this session is ValueInsights.ai. So I actually messed it up saying it the first time so I could say it over and over and over again.
Perfect. Just like we planned it.
Right. And now, just a brief reminder for CPE credit for those of you who haven't heard this yet so far today. There will be 3 breaks during the session, and during each break, at the end of each break, we will display a CPE code on the bottom of the screen. It's a 3-digit code, so you'll get 3 of those, altogether 9 digits. You need to write those codes down each time you see one of them, because those are the codes that enable you to get your CPE and CE credit for this session. I just want to point out, if you're looking for CE credit, just do it the same way as if you're getting CPE, even if you don't need CPE. Take down the codes. You'll go to the screen. At the top of our screen, it says CPE/CE credit. You'll go there, you'll enter the codes, and you'll click to download the certificate. Even if you don't need the CPE, do that anyway. Click to download the certificate, and that gets you into our system to dispatch your CE credit to the IRS. Okay. And when we do display the codes on the screen, we'll make sure that you are paying attention and ready to write down that code, and you will hear this sound. Okay, that's your cue that there's a code on the screen, you need to write it down. So this session is the One Big Beautiful Bill Act, Individual Tax Reforms. So this is part 1 of the One Big Beautiful Bill Act. Tomorrow we'll be talking about corporate tax reforms. We are joined today by our panelists, Todd Gray, Nadia Rodriguez, and Sean Duncan, and my co-moderator, Alexandra DeFelice, and I'll have them each introduce themselves to you right now. Todd?
My name's Todd Gray. I am the founder and CEO of ValueInsights.ai. We are a web-based, AI-backed application that helps to identify, substantiate, evaluate, and document non-cash contributions with a simple click of your camera.
And this app just launched like this month, right?
Yeah.
Okay.
Yep. It's been a pet project for a number of years now, and finally have the technology and to let it run, and it's fantastic.
Cool.
Yeah.
Nadia?
Hello, everyone. My name is Nadia Rodriguez. I'm a CPA based out of Dallas, Texas, where I have my tax firm and we help our clients with tax advisory, tax compliance. I'm also the founder of Nadia CPA Inner Circle, which is an online source for tax professionals to come together. We learn together, we grow together, we succeed together.
Very nice. Sean.
Hey guys, I'm Sean Duncan, the owner of SMD Consulting and Accounting. I'm actually based here in North Dallas as well. I kind of operate a lot like a family office, so we do wealth management and law as part of that package. I'll explain how that works if you care. But my specialty is advisory. We actually specialize in helping self-employed physicians and software developers. Self-employed physicians so much so that I literally did just have a book come out 3 weeks ago, shameless plug, Tax RX. If you feel like hitting Amazon, let me know. Or just do it. And then the other is software developers, but really video game developers, because I play a lot of video games and it's fun to talk to them as clients because I get to pick my clients.
Very nice.
And I'm Alexandra DeFelice, Chief Marketing and Business Development Officer for JMBM Law Firm in Los Angeles. Designated bell ringer most of the time. There might be some competition later. And co-moderator with Gail for the whole 2 days.
Excellent. Thank you all so much. I think we want to start this session by finding out a little information from our audience. So Alexandra's going to post some polls for you.
Yeah, I think I've decided I'm going to post one poll at the beginning and one poll at the end. So the question that we're going to ask now is about what documents your clients provide annually for non-cash contributions. And we'll put that out there, and then we'll get the answers, and we'll come back. So.
Okay.
Cool.
All right. Meanwhile, most of you are probably familiar with the One Big Beautiful Bill Act, particularly because I know you're watching this session, so you probably have heard of it. There is an interesting movement afoot in Congress to try and get the name of the bill changed to, I think it's the Working Families Tax Act, I think, or something like that.
Yeah.
Anyway, for now, it's still
It'll
the one
change
big.
10 times,
yeah,
so we're just going to go with that.
Call it what you want. It's the One Big Beautiful Bill Act, and the great thing about it, the thing that is beautiful about it, I think, from the perspective of a tax preparer, I'm that as well as the editor of the CPA Practice Advisor, is that there is something for everyone. Every single client you have is impacted somehow, even if it's in a minor way, but there are so many changes. It gives all of us a great opportunity to connect with our tax clients and explain to them what's happening and be their best friend. So I think we want to start with talking about some of the changes that are going through the Schedule A. So Todd, do you want to jump in with some information on that?
Yeah. So I think one of the main things that I run across being a California-based CPA, the SALT limitation was a huge win for me and my clients. When it comes to, high property tax, high income tax states, we benefited a lot from that. When all the tax law changed originally, it was kind of shot across the bow at California, and all of my clients were mad at me for it. And I didn't like that, so I'm thankful that they changed that. So all of a sudden, Schedule A became a lot more valuable. And yeah.
What was kind of cool about it, when we were prepping for this, we were talking about the difference, because you're in California and we're Texans, and we're not enemies even though we're in those states. The SALT tax didn't affect us as much. So in California, obviously, you can get up to $40,000. Yeah. You have the huge income tax. Mm-hmm. We don't. Yeah. So a lot of our clients, and the way the phase out worked, a lot of my clients are higher earners. They're physicians, they're successful software developers. Yeah. They looked at me and it was a big giant nothing burger. It was like, oh, okay, so it's 40,000, but if I make too much money, then it goes back to 10? Yeah. So how does this help me? And it kind of doesn't. So it depends very largely on which state you're in. So California, this was a huge boon. Texas and Florida, neat. So it's funny, is like the different perspective, it really does matter on who the preparer is and what their client looks like.
Yeah.
It does, and it is temporary, right?
Right.
It goes back to 10,000 in 2030.
Yes.
Yeah. So it's a great benefit for those high income taxpayers
For sure.
in those states.
Yeah, I think it really is, and it's a situation. I mean, are there any circumstances where people can bunch deductions so that maybe they don't get more than the 40,000 or up to the 40,000 in 1 year, but they can make it work and itemize 1 year and standard deduction the next?
Well, Sean and I were talking about, when we were getting everything set up, of taking some of the other business deductions to drive down AGI, to then fall into some of those income thresholds, and kind of bunch together all of the different things to really maximize Schedule A.
Yeah, definitely it takes a lot of planning because of the AGI limits, and then also Schedule A. the itemized, miscellaneous itemized is never coming back.
I know,
Yeah.
that's
And,
so sad.
and we were talking about
You're
during our break about how we have taxpayer clients who have those unreimbursed employee expenses, especially now working from home.
Yeah.
And that's not coming. We were hopeful that maybe it would come back, and it didn't. The One Big Beautiful Bill just eliminated it permanently. But what is staying with miscellaneous itemized deductions is educator expenses, up to $300. And even now coaches are included as part of the educators.
Nice,
Yeah.
nice. So everybody needs to go out and start, get an assistant coaching job on their kids'
Oh
team.
yeah, yeah. Right.
I
Just
mean, do you mean that kind of coaching, or do you mean business coaching?
Oh, no.
coaching.
Anything, it's broadly defined.
I taught you something today. Congratulations! I bought some books. Like it literally can be. It's tax law. It's great.
Interscholastic coaching, yeah. So
Coaching, any coach. Well,
Yeah.
back to your point about the AGI tinkering with. So literally yesterday, so this is what we were chatting about the AGI. So I have a physician. He makes $300,000-400,000 taxable income before we start getting cute with anything. Basic S corp. Well, he's going to buy an airplane, and we got to hurry up and close on that airplane by the end of this year, which is going to cause a $600,000 deduction. Well, now we're going to fling him back to negative 300. Well, then we're going to go ahead and do some Roth conversions. Fling him back up. And so when we start playing with the AGI and doing bunching of deductions, this happens to be a massive business purchase. And it doesn't really affect the big, beautiful bill, but that same logic kind of applies to charitable donations. If you can do certain donations, shove your AGI down, then what we've started to do is open up a lot of these other provisions that have phase outs. So like things that phase out 150 or 300, if we can nudge you under, we might have just triggered a child tax credit or something like that. So there's this integration that we're starting to play with on how we can bunch up. Odd years will go standard deduction, even years will go bananas, and we start playing those games. But this is like what you do is all the advisory work is, let's talk about what the goal is, because try to do this on April 15th,
We're too late.
forget about it.
Yeah.
It's too late. So planning ahead, there's a lot of really cool tricks. The Big Beautiful Bill is overwhelming. There's way too
There's
much.
a lot to it.
I've talked to a lot of people that I've coached is like they can't keep up and they feel like they can't ever learn it.
Yeah.
You don't have to know all of it. Just start the pieces. Like we're talking about SALT and charitable and a couple deductions. Just pick a couple and build. But it's overwhelming to learn all this stuff for sure.
Yeah.
We're going to talk more about those in just a moment, but we have first a commercial break. It's actually Todd on the commercial who's going to tell us
It is.
a little bit more about Value Insights. And when we get back, we'll have our first CPE code for you.
What are your contributions costing you? Welcome. My name is Todd Gray, and I am the CEO and founder of ValueInsights.ai. As a 23-year veteran CPA with a tax practice in Carlsbad, California, I bring to you a new application that will revolutionize the way that we prepare the Form 8283 for non-cash contributions. The biggest problem with non-cash contributions is that we fundamentally lack an easy and effective way to identify, value, and document non-cash contributions. ValueInsights.ai is a web-based, AI-backed application that identifies, substantiates, evaluates, and documents your non-cash contributions with a simple click of your camera. As a 23-year veteran CPA, I know what this app needs to do and what information it needs to provide. And I developed it with industry experts to solve the pinch points that every CPA and their associated clients face on an annual basis. We too often receive incomplete or inaccurate documentation for the contributions our clients make throughout the year. We all receive contribution slips from Goodwill and Salvation Army that identify dates and very generic contribution information, but lack the valuable and vital information for the preparation of the tax returns. We as the CPA are left in a position where we are either following up with the client endlessly to obtain pertinent information, or worse, we guesstimate based off of the best available information to keep the returns moving through the process. Each of these two pinch points are costly to you as the preparer and the underlying client. Look, I want you as the CPA to have a valuable resource to lighten your preparation backpack and prepare a more efficient and accurate tax return, and charge more for it. This is a win-win situation for everyone. Check out valueinsights.ai.
Do it.
All right, we are back. We'd like to display for you now, be sure to write it down, the first CPE code for this session. Make sure you make note of this if you're planning on collecting CPE or CE credit, or CPE and CE credit for attending this session. Okay, we were talking at the break, we think the place to go is to continue our discussion about planning opportunities regarding lowering AGI, and there's so much going on right now that there's so many opportunities for accountants to work with their clients and make a difference. Nadia, do you want to jump into that?
Yeah, so we have the 4 new deductions from the One Big Beautiful Bill that are new this year in 2025. They take into place. They are temporary. The last year we can benefit from these are in 2028, but it has to do with AGI limitations. So when our clients approach us, if the no tax on tips, no tax on overtime, I think our first step is let's look at their AGI. Would they even qualify for this? Are they even in an industry where it's customarily one that receives tips? We can't just say today, oh, I'm selling shirts online and all of a sudden I'm starting to get paid some tips.
Yeah.
We have to first start educating our clients on that. So we have the no tax on tips. It's a deduction up to $25,000 for qualified tips. And this is the thing that I'm talking about. The W-2 form and the 1099 forms are not going to change. And so how do us, the tax preparers, help our clients determine the amount of qualified tips? We know the W-2 has a box 7 for Social Security tips. But then what about that self-employed individual that's the hairstylist receiving tips? They're usually not accounting for the separation of regular service income versus tip income.
Or reporting it all.
Yeah.
I mean, come on, that was accidentally fell on the ground. Yeah, we do have to
Yes.
educate them on, because this is now a different reporting requirement. Yes, we know the IRS is underfunded and understaffed, and they're still not going to chase it down. But my concern is people always talk about, am I going to get caught? But we don't, like you said, and you said this in prep, do we have the documentation we need to even do it right in the first place? We are all in the same boat of like, we know we have to do it, but we don't even know where to put it on the return. And I have a feeling we're going to have a little bit of chaos, that those people that are used to doing returns in January, it ain't happening.
Yeah,
we're gonna be cut. But it depends on your client mix too. I mean, if you're not, I have only a very few that even deal with tips and overtime, but there's some people that are gonna be drowning in them, and they're not even gonna start returns until February.
Well, and they're actually asking about that in particular. It's so weird. It's like people will just bring things up on the panel, and the question comes in like as it's like
it's his
right
valuable.
before.
Yeah, it's this.
But they said, what's the best way to address the tips and the overtimes on the form? But it said, what if the employer has not provided it? Should we put the responsibility on the clients for the truth?
Yes.
I think that's the best we're going to be able to do, is have that conversation with our clients and document what are you accounting for service tips versus just regular income. And the rule does say that what has to be reported on tip income has to have come through on included part of 1099 miscellaneous or either the NEC. So if it's not on there for those clients that are receiving tips through Zelle, they're not going to receive a 1099 for that. And the law currently says you cannot account as that for your tip deduction. It's going to be taxable income, but you're not going to qualify for that type of tip deduction.
It's almost like bookkeeping matters. It's kind of weird. We have to keep, but you're right. We're going to be drowning. One, we don't know what the forms are going to look like, so how are we going to say it? How are we going to present that? But do the clients even have the records? Now, I will say, if we're preparing the returns and you've had that client for years, this is that moment where we jump into advisory and say, we might need to get this organized because this rule has changed. And if their books don't show tip splits, they don't show overtime. Oh my gosh, overtime. Just wait till we get into that paperwork that goes with it.
Oh, yeah.
And again, state rules. We talked about that. California different than Texas, different than New York. We're gonna have to really lean on the clients more for better bookkeeping, better quality bookkeeping, because this Excel spreadsheet version of life is not gonna happen in our clients anymore.
Well, and it's not just our clients who are receiving overtime and tips, it's our clients who are employers who are providing those. And I think it was just last week the IRS did issue guidance, guidance, not like you have to do it, but guidance for employers on how to help provide the information to their employees on what they need to report on their tax returns. So it's a start, but it's not nearly enough.
Yeah, it's two sides of the coin, right? The recipient of the payroll and the deliverer, and then we all have different payroll or reporting requirements with it.
So I really think 2025 is one of those that communication is key. amongst the tax professional community.
Right.
How are we handling this with our clients? Let's try to find a consistent way, because there really isn't guidance on this is exactly how it needs to get reported. 2026 looks better. The forms are changing for 2026, but 2025 is definitely one of those that we're going to do the best that we can with the knowledge and data that we have.
Yeah.
And to throw a little best practice just into it, so we talked about, is the responsibility on the client or on us? It's ultimately on the client, but we're signing off on things.
Yes.
So get it in writing, document what you have. But and the previous presenter sponsor, Canopy, right? They capture all of your emails. So all you got to do is email, are you sure there were no tips this year? And when they say no tips, congratulations, it's already archived in your practice management by virtue of that link. So document the crud out of it, and you can even be overt. I've done this with clients. I need you to tell me in writing, you don't want to take this tax deduction because I know if they freak out that they paid $40,000 because of my strategy, I don't want them mad at me. So over document, and email is your friend, man. Get it in writing.
In writing, for sure. For sure, in writing.
So as long as we're moving down the Schedule A, what in the world have they done to charitable contributions? Oh my God.
I think I know an expert. Do you want to jump in that?
Yes, please.
I think Todd wanted to address that.
Yeah. So, in planning for this and discussions amongst the three of us, we talked about the things that move around on Schedule A, right? And the mortgage interest and all of those things, we already know the caps to those. And the SALT limitation is helpful, but charitable contributions are the other big variable that you can move around, right? And with the tax law change coming into 2026, where we're all of a sudden going to have a 0.5% AGI limitation, we need to try and pull some of those contributions back, try and maximize the value, because 2025 is going to be the best, not the best possible, but it's a planning opportunity to really take advantage of that before you're getting a haircut, or actually, we'll call it a floor, that you got to get above. It's all of a sudden the same way that medical expenses really have become irrelevant because of that AGI floor.
And that's where the doubling up part comes in, where you were saying is like, how do we mix it? And it's planning. It's planning and planning and planning. How can we plan this out ahead of time and having the conversations? I tend to deal with a lot of high net worth people, so we're having a lot of conversations around, are we going to do a donor advised fund? Are we going to do a CLAT? And that's the big bites. And so that's, like you said, is if 2025 is the year that we can get a big bite of the apple, let's take all those future contributions and bring them into this year. But that'll immediately get you over the threshold. And you just exceed that, hey, next year I'm only going to do standard deduction. I'm fine with that. And if, again, as advisory people here, we can look ahead and know what that impact is going to be and plan cash, and we can plan other donations.
Well,
But the clock's ticking. We've got like a couple of weeks left of 2025.
And some of us close from Christmas to New Year. So really there's a very slim window, and the clients are going to come running in on December 28th and ask a question. How are you going to handle that? Do you know what your answer is?
Yeah, and the other thing to also layer into that is the fact that for 2026, we also have the $1,000 and $2,000 single and married filing joint
above the line.
the line deduction. So you could have the standard deduction and have cash contributions coming out on in 2026, which would be great.
So really,
please.
I was going to say, really distinguishing, do we itemize this year, because next year we're going to use the standard deduction, and that's where we'll add some charitable contributions. Do we even qualify for Schedule A? Is there enough itemized in 2025 to make that decision?
2 weeks to do it.
We have 2 weeks to decide.
Garage cleaning in the snow is the best way to do it.
And I wish there was an app to help you with that.
I will say, okay, so I'm going to shamelessly plug our sponsor. When we talk about, I'm going to compare it to S corporations and reasonable comp, right? We want the lowest possible wage for reasonable comp, and we need to substantiate that. Flip this the other way with charitable contributions. We want the highest possible value we can substantiate, and that's what I thought was so cool. As I may have been tinkering with the app a whole bunch, and you can find those collectibles and those things and value it based on what eBay and Craigslist and Etsy and Poshmark. I do know what Poshmark is. Okay, don't get me wrong. I'm pinky up, but the highest possible valuation that you can substantiate, that's actual money. Because I've had clients go, yeah, it's never worth it. I can only get a few $100, but you know their stuff is worth more than that. And I love that, because I can now pull that leather jacket and what it looks like, and it's not the $20, it's the 119 that your app may have told me it was.
Well, and then on top of that, you have the documentation.
Yep.
You have
That
the
is key.
reports. You have
Yes.
it's hitting all the key points, right? It's identifying, it's substantiating, it's evaluating, and then that document. Because if it ever does get questioned, you say, hey, here's what my report says, and here's all third-party independent research that says it. You prove me wrong.
You know what I love is that I now don't have to do it.
Yes.
Which is awesome
Yes,
because I'm
absolutely.
lazy. And I can blame the client because they ran the report.
And approved it, and approved the report.
yeah.
It adds a whole nother layer of accountability to that relationship, right? No longer are you looking at it saying, okay, well, what did you give? And like, well, can you give me a description? It's all in the report.
Yeah.
Hand over a stack of reports.
Sorry to hijack with the same shameless plug for them, but really I started tinkering. It was freaking cool. But I know you guys
Well,
don't want to do sales pitch, but
No,
that's really awesome.
This, real quick, this came from 2 decades of doing tax returns and being frustrated every single time.
All you had was the Salvation Army lists and
Yes.
Goodwill.
Yeah.
Everything was $5.
If you wanted something to back up, that's all you could get.
Yeah,
back it up.
and my clients, thankfully, they don't have $5 T-shirts
Yeah.
or you
Well,
know,
it's
polo
California.
shirts.
Everything's vintage $900 T-shirts.
Yeah, but that's a good tax deduction.
According to my daughter, a Guns N' Roses shirt is definitely worth 110. I haven't quite figured that out.
Yes.
Okay.
Yeah.
We're working on that.
Dig into your old closet.
I know.
All right, we're going to take one more quick break, hear a little bit more about our sponsor's product, Value Insights, and then we'll be back with our second CPE code.
As a veteran CPA, I want us to realize the value and power of charity. ValueInsights.ai is a web-based, AI-backed application that identifies, substantiates, evaluates, and documents your non-cash contributions with a simple click of your camera. This will enable us to calculate the estimated current tax savings generated by each appraisal report submitted per photo. The app is designed to capture the user's estimated federal tax rate and a flat 5% state tax rate at the initial setup. As finalized appraisals are approved, there is a running total for the estimated tax savings year to date. Value Insights offers the first 5 appraisals free for each new user. Therefore, your clients will have an opportunity to see the tax savings you enabled for them before purchasing credits for additional appraisals. The credits can be purchased individually or in bulk with discount per use pricing for bulk credits. The more you invest, the more you save. Appraisal credits do not expire and can be used anytime contributions are made. Each credit accounts for 1 qualifying appraisal. Let me show you how it works. As the user, log into the app, snap a photo or upload a photo from your files. Then complete some identifying information. Obviously, with the more identifying information, the better the results. There's a sliding scale for the condition of the items as required by IRS Publication 526. Once the relevant information is input, then just click Submit Appraisal. We have designed this app to rely on prior and current sales transactions and identifying information to find equivalent and comparable sales to substantiate and document the estimated fair market value of the item. The app then generates and delivers a written appraisal report for your client to review for accuracy and self-certification. If additional information is needed for proper matching, the information can be revised and the appraisal resubmitted for additional analysis. Ultimately, the client is responsible for the entry of the photos and relevant information. They then approve the delivered appraisal report. The finalized appraisal report is then available for printing or download by the client. The intention is to provide a reasonable, rational, and defendable appraisal report to couple with the underlying charity receipt for each contribution made. In addition to presenting you with a more valuable tax return you can charge your clients more for, we're also offering a 10% revenue share for the first 2 years for the first 200 CPAs that sign up. You will be provided with a code that will enable your clients to be tracked within the app and allow for us to share in the growth of this tool as it applies to your practice. This tool is designed for us to benefit us and enable everyone to share in the value of non-cash contributions. You make the impact, we maximize the value. Check out valueinsights.ai.
That's what I've got.
Welcome back. We'd like you to direct your eyes to the bottom of the screen where you'll see the second CPE code for this session.
No.
All right, be sure to write that down if you're planning on claiming CPE or CE credit for this session. We'd like to get back into a little bit more conversation about the fun things going on Schedule A this year. So let's talk about the car loan interest situation first. Who wants to jump in on that?
Situation. Well, we're back to different states, right? I'll let Nadia start
Yeah.
out first because she probably has a good thought on it. And then
Yeah, so the car loan interest, it's going to be a deduction below the line. And it's up to $10,000 of car loan interest that you pay for the year. First, I want to know who pays that much in interest for a car loan. I think the average is about maybe $2,000 to $3,000.
Wait, did
You
you
don't have
say
my
below
clients.
the line or above the line?
It's below the line.
Okay.
It'd be a deduction just like where we have a new schedule.
Yeah.
New schedule 1A
Okay.
is where they're going to plug in these 4 new deductions with the one big beautiful bill. And I'm assuming it comes right below the qualified business income deduction or a standard
But it's,
deduction
you don't have
itemized.
to itemize.
You don't have to itemize.
That's-
No,
yeah.
this is going to be below the line. It's $10,000. The loan has to have originated after December 31st of 2024.
and
It's
it has to be a
only new
U.S.
loans.
assembly car too.
It is, yes.
And does
There's
it
a
have
lot
to
of
be a new
caveats.
car?
It doesn't have to be a new car. It just has to be a new loan.
New loan.
Okay.
And it has to, yes, final assembly in the U.S.
Okay.
And there are AGI limits then.
Yeah, I was
you
gonna
said
say,
to
can't
the
we just make it a
AGI.
little more confusing?
Yeah.
And I think you said, Nadia, you even have to have like your VIN number ready. Do you have to put that on your tax
sure.
returns?
Yeah,
Yeah.
in our organizers, we need to start asking for that. Did you pay car loan interest? When was the date of this loan? Okay, where's your VIN number? Because they're going to need it for electronic filing of the return.
And we're right back to client mix too, depending on who your client is. Again, my clients are typically surgeons, medical practice owners, and so we deal with $250,000 plus of income. So if
They're
you're
not going to qualify for this
That's
anyway.
exactly it. It was a giant eye roll again. So they're
Yeah.
like, can we get the salt tax 40,000 on? Oh no. Can we get the car? Oh no. So we're having a lot of, except my airplane guy, we can shove him clear back down and then get
Right,
him into
right.
100,000 and now he can
Back
get his
and forth.
interest. So we're stacking stuff by playing the game. But yeah, there was again, depends on your client mix.
It does, but that goes more towards the theory that this tax bill was supposed to be geared towards working families, and, people who are in the trenches. So
Some of it, yeah. There's,
There
particularly
are
when you
some
get some things that are like,
extra
I'm really glad we have a $15 million
Yes,
estate
yes.
limit
Yeah, there
now.
we go.
By golly, we needed that.
yeah, exactly.
Yes.
But yeah, there's a lot of things that are for the working class citizen, which is pretty cool because all the previous iteration of the major tax law was all geared toward business owners and real estate investors.
Yeah.
So we're getting a little bit of a balance to it. But car loan interest, try it, but the phase outs tend to be a kick in the tail.
That is a lower phase out of the 4 new deductions.
Yeah.
Definitely.
Yes.
Definitely.
So let's move on to what was supposed to be the no tax and Social Security deduction, and then it became the senior deduction, and you don't even have to be taking Social Security to get it.
Yeah.
So
That is correct. And I think there's a lot of miscommunication. There was an official press release from the Social Security
Yes.
Administration about no tax on tips.
Yeah.
And it really is. You do not have to receive benefits from Social Security. You just have to meet the age requirement and the AGI requirement too, because it does also phase out.
Yeah, yeah.
But yes, if you're 65 and over, that's $6,000. You have a married filing joint couple, both of them are over 65 or over, that's $6,000 per taxpayer of a deduction.
yeah.
And I surmise, and this is my rampant weird theory, it's a concession to the stealing of our exemptions. It's like, so when everything was marketed, we got a higher standard deduction. Congratulations, everybody's standard deduction's higher. Yeah, but behind the scenes, they took $4,000 per household. And look, me with 3 little rugrats, that's $20K you took. Now, I'm not 65 yet, I'm getting there real quick. But I think it starts to balance that out again. You get your standard deduction plus a bonus 12. That's really, really meaningful for that segment of society. And I've got a lot of clients that are super excited because it truly is just, oh wait, I don't have to do anything? I get
Right.
12,000?
Yeah.
Great.
And then the great thing that's on top of the additional deduction that we already had for seniors, that gets added to their standard deduction,
Yeah.
which I think for 2025 is $2,000 per senior, but if you're married filing joint, it's limited to $3,200. So this is completely separate. This is on top of that.
So hey, Nadia, what if I adopt a 65-year-old? Do I get to take it?
That they would have to file their own taxes.
Oh, darn it. Okay.
They wouldn't have to defend
I thought I had a loophole.
That's one situation
Great
where people are going to
creativity.
want to increase their age. I'm really 65. Really believe it.
Yeah.
I yell, get off my lawn a lot. Does that count?
You're getting there. All right. So one of the more confusing aspects of the Big Beautiful Bill is what they've done to gambling income and losses. And we want to try and help explain it to you in such a way that you'll be able to explain it to your clients as to why they're paying tax on income they didn't get.
So when we were game planning, I had proposed a position. I've got a client that $100,000 win in 2026. If you broke even, right, $100,000 of winnings, $100,000 of losses, the losses are subject to a 90% limit. So now you are paying tax on 10% that you never got. It's with a casino or wherever, but you're paying tax on money that you never walked away with.
Yeah, and it's going to cause a lot of phantom income.
Yes.
So there was options, though, right? Isn't there a way around it?
There is not a way around it.
No.
They're a little bit of social engineering. Maybe they're trying to get people to stop gambling. I don't know what's going on, but yeah, it's
There was no logic written in any of the legislation notes that I've seen.
And there's a lot of pushback by casino owners on this.
Oh, sure.
Because
Yeah.
they think
Oh,
this
yeah.
is going to lower their.
It will.
Oh, for sure.
And there was never anything done. Never got. I mean, it's still law.
Yeah.
Yeah, I mean, I grew up in a gambling family, and in my family, you either won or you had fun. Well, in 2026, you're not having fun because you're going to pay tax on money that you didn't get.
Yes.
So, yeah.
And what's important to realize is, and this is the pushback for the gambling casinos as well, is their reporting requirements are going to have to change. Because currently they give you your report. Okay, I played slots for X number of hours, and this is my net winnings.
Yep.
They don't say wins and loss number, it's net. Well, now they're going to have to give us the wins and losses so we can pay tax on that even if our losses are greater than our wins.
Yes.
And that's where it's going to get really stinky for people because the casinos have to do reporting. And does anybody remember when payroll and 1099Bs had to change and all the, it's going to lag. And so there's going to be a year or two, I think, of guessing that we're going to self-report before the new version of a 1099K comes out because that's what's going to happen. They're going to have some new report they're going to have to issue, and the casinos are going to have to update their software accordingly.
Oh yeah, and I think Alexandra, what you're talking about the workaround, it's more of the session. If it's a lot of calculations there, and a lot of tracking where our taxpayers have to be good about documenting when they leave that table. Have they tracked exactly how much they won and how much they put in? And then when they move on to the next table, let's do it all over again.
Yeah.
So
I'm not card counting, I'm cash counting.
Yes, exactly.
Right.
Exactly.
But yeah, that's a way, but it's going to be really hard to track if we have taxpayer clients like that.
And if you win a lot on fantasy football, still nobody's reporting that, so I don't know if we can ever capture that piece.
Okay, now how many of you are really excited about Trump accounts?
Hey, if you're having a baby,
Yeah, I was going to
it's
say,
for
yes.
sure.
Free money.
Yeah.
Yeah.
yes, the year's 2025 through 2028. If there's a newborn baby, they're a trust fund baby, basically.
Yeah,
exactly.
Getting $1,000 for free.
Here's your free $1,000. Congratulations. But
It's not free because you'll pay tax on it
Yes,
eventually.
Yeah.
exactly.
fair
Yeah.
enough. Yeah,
True.
it is. It's cool that there's $1,000 thrown into it. That's great. It's a little neat little gift for that little window of kids. Please don't have your clients put money into it. I mean, think about it. Why do we do traditional IRAs or retirement accounts? I get my deduction, but I have to pay tax later. Well, why do I do Roth? So I pass on my deduction so I don't have to pay tax later. Hey, I know, let's do a Trump account. I get no deduction and I pay tax.
Yeah.
It's literally the worst of both worlds. And I've already had people come up and say, I want to overfund it.
Oh my God.
And it's the worst tax strategy you could possibly ever do on a retirement account. I've got 10 other tricks for you, so take the 1,000. But please, guys, don't tell your clients to put money into them. And this is not political, that is financial. So whatever you think about it, regardless of the name that's on it, it's bad financial advice if you tell them to put their money in an account, and you're going to get in trouble.
Definitely.
I think you're right.
Yeah.
I want to take a moment just for the shameless plug, because obviously this session is sponsored by ValueInsights.ai, and we've had some people contacting us in the questions asking where do they go to get it, which is?
The website, ValueInsights.ai.
There you go.
Make it as easy as possible.
You
And
guys
I've
have
got-
to move so they could see it behind your back, right?
Yeah, right? There you go. Or look on our foreheads.
Yeah,
here.
exactly.
And I have a question. Will the Value Insights AI app be available for individuals who file their own tax returns, or is it only for accountants?
No, it's absolutely not only for accountants. It's for anybody and everybody that wants to use it. It is, as I had said before, this was a pain point for me. Preparing individual returns and seeing people giving away things and giving away deductions and value that nobody's ever capturing. I wanted to help with that, and it helps everyone.
Okay, I've got a cool second use. though.
Yes.
So I already told him what his next evolution of this is. If you're selling stuff on eBay or on Facebook Marketplace and you want to know what to charge for it, you can also use it as a pricing tool.
Yeah,
I'm
we're
just
already
saying,
working
you'll
it.
know
Yeah.
what the market study is. So if you are doing this as a side hustle and you're selling stuff on eBay or you have friends, do that as a little bonus thing. Hey, by the way, this app will help you figure out what the market, because it's telling you regional markets of equivalent sales. That's pretty cool for a pricing tool. So get ready for pricinginsights.ai. And I'm going to get a royalty, right?
Absolutely.
So we had a comment, and maybe you can opine on it or not, because I always like to throw pricing into everything. But they're like, this is so much information. This is going to take me so much time. How do I charge the client for the extra time that it's helping me to help them?
So here's the best part about it is the fact that the way the pricing is set up, this is all user-based, right? So this is an app that is on my phone that benefits me. It's the reports that go to the CPA. The CPA gets to prepare the return and charge more. And the client is the one that is paying the cost of the app, and it's a per-use transaction, right? So you're getting, it's a matchup of cost and benefit. And the benefit has outweighed the cost every single time.
Let's say they're not using the tool. I think what the question was more about.
Beautiful bill entirely.
Yes,
That's where we
the
kind of
knowledge,
come in.
knowledge time that they had to put in learning about this stuff.
But why? But that puts the onus on us as the CPA, as the decision. That shouldn't be my decision. These are your contributions and your value, and it's your tax return. You should take some accountability for what it is, right?
But I think that there is an advisory opportunity to cash flow
sure.
on this.
Definitely.
I can think of dozens of different ways. One quickie is maybe you are the one with the app and you ask your client to give you the information and details. Well, then you're going to say, by the way, for an extra X number of dollars, percentage of the tax return, we can't contingency fee. We know that per our license. But an extra $200, I'll help you maximize your charitable contributions this year. Do you want to do that? And then they can make a value prop. But really, I do subscription-based. I think you do subscription-based.
Yes.
So subscription-based, relationship-related work throughout the year, meet with them throughout the year, set up that, and now you're not tracking time, because I don't want to be punished because I've got an efficient tool. I want to be paid for the value that I bring.
Yeah.
So if you have not looked into pricing, if you've not gone into researching different ways to do it, find another methodology than time and start getting into value. And I would say subscriptions or project-based work is the way to go. And there's a lot of case studies, whether it's Ron Baker's books or it's coaching that I do. There's a ton of materials out there. Please move away from hourly. So if you're doing that time, I want you to get paid for it. Figure out what package. Is it $200 just for the contribution add-on? Am I going to upsell to a subscription? Do I do end-of-year planning package? Find a methodology that works for your client base and then charge for the project or the relationship and not the time. I don't know if that's how you do yours as well.
And I think right now with the tax law updates, with the One Big Beautiful Bill, it's an amazing opportunity to offer these type of services because yes, there's a lot of information, but it's going to take us forever to sit with our client, for each one of our clients, and really evaluate every single tax law with them. It's more that relationship that we're having with them throughout the year.
Definitely.
Because their situations change and you want to be ready for it.
Yeah.
Okay, we do have one correction. Several readers attendees pointed it out to us, and I did double check the IRS website. The auto loan interest deduction is on new cars only.
Oh, it has to be brand new cars.
It has to be a brand new car. And then all the other stuff
That
has
is
to be
great to
assembled
know.
in the States. And,
Got it.
Yeah.
Yeah.
You guys are awesome. Crowdfunding or crowdsourcing this.
All right, and I think...
Did I say it was
Did you
overwhelming?
want to send out a poll?
All these watching.
Oh, well, yeah, because we're almost at the end,
Yeah.
right?
Yeah.
So we want to kind of see whether this session has helped you, and if you feel more comfortable talking to your clients about some or not all, probably not all of these changes. We just want to see how good these guys are. Let me see if I'll let Sean ring the bell on the third
Oh
time.
gosh, come on. It's the best
We'll
ever.
wait
It's the
till
best
we
ever.
get poll results, and then we'll do the last CPE.
Yeah.
Any other last comments while we're waiting on that?
I think actually Sean wanted to talk on opportunity zones just for a
Yeah,
little
go
bit.
for it.
Okay.
Yeah,
Okay.
I think we
I know
should
that
do
I think you had a whole session on op zones, right?
No, we don't.
I
this
did in my law firm.
At your law. Okay.
This is our one moment.
They did reinvigorate the opportunity zones. And now I'm not going to go into a whole long lecture on it. Take a look at it again, because again, remember, if you invest in a proper opportunity zone, so you sold an asset of some cap gain, you put that money into an op zone. And when you put that money into an op zone, you can defer the tax for 5 years. And then after 5 years, you pay some tax, but your basis gets adjusted. So it may not even be the full tax. And I'm way oversimplifying the rule. But then if you hold on to that asset for another 5 years, you get a step up in basis. Just like the estate planning thing where your entire asset steps up in basis, you can pay 0 tax. Now, everybody's used to talking about real estate. It's not only real estate. This is not a 1031 exchange. It's all assets. So I'll give you an example of a client of mine has whiskey barrels. He sold his office condo. He took his hundreds of thousands of dollars of gains and he bought a bunch of whiskey barrels that he stores. Happens to be in an Oklahoma opportunity zone. It's an asset in the opportunity zone. Well, he has to age that stuff at least 10 years for the whiskey he wants to sell, so he parks it there. He's going to wait the 5 years. He's going to get his adjusted tax on that, and then he's going to hold on to it another 10 years, get a full step up in basis, and no tax on the capital gain of that asset.
Is he storing this in Tulsa? Because I think there's a TV show about that.
Broken Bow, Broken Bow, Oklahoma, y'all.
Okay.
So, but there's a. Don't think into the channel. Don't be myopic. It's real estate only, because we fall into that trap with op zones because they're talking about the location. It's the location of the asset. It's any asset. So keep that in mind. There's a lot of really cool stuff you can do with it if you're creative. Look out there, hit the Google machine. It'll give you tips as well. Just don't follow all their advice. Go to experts if you need
Okay,
help.
before we give you the exciting poll results, we want to give you the last CPE code for this session. That's going to appear on the bottom of your screen now, and you're going to be advised that it's time to watch the screen because Sean is our guest bell ringer.
Oh, the power.
All right. If you are expecting to get CPE or CE credit for this session, you'll want to make sure that you write down that code. And we'll let that stay up there for another, 10, 15 seconds or so. And as soon as it's off, well, it looks like it's off, we can go ahead and display the poll results.
All right. Well, luckily for Sean, that's why he was able to ring that bell, because almost 50% of the people said that they do feel more comfortable, but they're still limited on what they're comfortable with. But 37% they said they feel much more comfortable, and that you guys are geniuses. 57 people said, sorry, I dozed off. And
Y'all, come on. I have
must-
so much caffeine. How could you have dozed off?
At least they had to have been awake
At least-
3 times to hear the bell.
That's a
Get
good
it
point.
going.
Yeah.
So there's that.
yeah.
All right. Well, we really want to thank all of you. Do you have any parting moments before we go? Any last things you want to say about the OBBBA individuals?
I just think 2025 is a great planning opportunity to bunch charitable contributions, try and pull back, and really try and drive down that. But whether it's AGI and maximize itemized deductions, yeah.
Yes, most definitely pull the reports for your clients on AGI. Are we close or not close to the limit of those exclusions, of those deductions that are limited? And start updating your organizers, because we need to know, did our client earn any overtime? We've never had a no or didn't care. We just know they got paid a W-2. Now we need to ask the question.
Oh, and you wanted them to get their pay stub.
Oh,
Yes.
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 That is a best practice that I am thinking about doing. Talking to other professionals too, is asking for the last paycheck stub of the year, because a W-2 is not going to show us anywhere on there the amount of overtime.
Yeah, and really mine is like, guys, this is overwhelming. There's a lot of stuff in here. Don't feel like you have to truly know everything. That's one of the dilemmas we have, is the imposter syndrome that we have as CPAs. We're supposed to know everything, or my client's going to think less. Make suggestions. Create little summary lists. That's literally what this is, because I can't memorize this stuff. And that's not even counting what ADP's coming in tomorrow and telling you about the business side, which, by the way, Michael tomorrow, he's a freaking genius. I've stolen information from him. I even reference him in my book. He's that smart. So be here for the BBB tomorrow. But it's too much to try to absorb in one shot. Take it in pieces. You got it. Just give yourself time and be patient.
And the name of your book is?
Oh, Tax RX, the Self-Employed Physician's Tax Guide. But yeah, it's on Amazon. I actually reference BBB in there as well. So because I was writing it while they were changing the rules, so I was in the middle of updating my book because they were changing laws on me.
Okay. And I'm going to keep you here longer, so we've got like 2 minutes left to make sure we meet the requirements for CPE. So any suggestions for how you should contact your clients, what you should say to them in the next 2 weeks in order to get them on board with preparing the information you need and maybe be able to help them out with some of the changes in the new tax law?
I do want to say is communication. Communication is key with our clients, reaching those, especially with the child tax credit. Yeah. Changes came in that are going to be a financial impact for many families because now the child tax credit did go up finally to $2,200. It had been $2,000 for a while. Yeah. Now it's $2,200, and then going forward, it's going to go up based on inflation, which is amazing. Mm-hmm. However, the new rule that came is that the taxpayer claiming that child tax credit must have a valid Social Security number. So ITIN holders are no longer available to be qualifying for that child tax credit. So it does impact a lot of families. I think we have over 5 million ITIN holders. And so that has never been a rule until now, starting 2025, and that can create a financial impact.
So if they get a Social Security number right now, are they good for this year? Or?
Yes, as long as by the time we're filing your return, you have a valid Social Security number that is authorized to work.
Excellent.
And realistically, planning for this year, some of these things resonated with you. Like there's certain things that the SALT was cool, or the tax on tips that it relates to your clients. Pick the 2 or 3 that you really feel like you kind of got a grasp on, then go into your client mix and find out who that relates to and where you might be able to help. You obviously have last year's tax return. Those are the people you contact. Don't try to write a blast email to tell every single client the possibilities, and then you're going to write a 9-page dissertation on the law. Pick the subset so that you can get some tangible ROI. That actually will make you money. But if you send a blast newsletter out, most of your clients are going to ignore it. Email Joe and say, Joe, I noticed this SALT tax thing. You're in California. This is going to help, and here's what I think. I've got some ideas. Let's chat. Let's do a meeting for $8 billion for the hour, or whatever you want to do. Pricing is. Cherry pick. You can't do this blast version because we are literally running out of time. So let's pick the shots where you can get some money out of it. You know your clients. You know who's going to respond. That's what I would do actionable for the end of this year, just to get yourself some extra cash flow.
Yeah.
Okay.
I agree. Yeah, just planning and communication. I mean, I know for my clients, I'm trying to hammer home as many of these things and keep up that dialogue, especially coming into year end. And I think it's just really leaning into that.
Okay.
And one thing we didn't touch on super hard is the 529.
Oh yeah.
I encourage you, if you have anybody that's got students of any age, because it actually applies to K through 12. They've really expanded it. They've increased the dollar amount, and they've increased what you can spend it on. We can spend it on certifications.
For CPA, yes.
Dig into it. I think it might actually be self-serving, not only for your family, but maybe for you as well.
Yeah.
It's a lot broader rules. And I know we didn't touch on it in depth, but it was one that I feel like that's an area when we're back to what clients might resonate with. Look, if they've got kids, it probably applies. If anybody went to school or learned something, it might apply.
Yeah.
All right. Thank you all so very much. This was a great session. Thank you, ValueInsights.ai, for sponsoring this. We will see you back at the top of the hour with our final session for the day, which is, one second, I'll read it to you. It is staffing, and that includes outsourcing, offshoring, remote, temporary, hybrid, hanging around the water cooler, whatever you can think of about your staff and where they are and what you're doing with them. We're going to talk about it in the next session, so we'll see you then.